Hello, I'm going to walk you through the main concepts in Chapter 1, which is the foundation of financial accounting. I'm using some of the PowerPoint slides, so this may be helpful to you if you use the student PowerPoint that's posted in D2L. All right, this is financial accounting. Financial accounting is done primarily for the benefit of people outside the company. Now, accounting information helps people make decisions about the company. And as we see here, there's a whole list of people who use information. The top two, investors or potential investors, and creditors, are usually the main two categories that we're talking about here. Okay, next slide. Right? Financial accounting, as I just said, is used to provide information to external users. The main two functions of financial accounting are to measure the business activities, so determine what's happened, and then communicate those things to external parties so they can make decisions. Okay, this is the framework for it, is that companies have activities that happen, and we'll talk about that more later. Accountants measure that, record it, and communicate it to outsiders, primarily investors and creditors, to make decisions about the company. All right, business structures. There are three primary forms of business. Corporation is a company that is legally separate from its owners. And the main advantage of that is that the owners or stockholders have limited liability, which means that all they can be held liable for or all they can lose is what they paid for the stock. They are not held liable for any debts of the company. Sole proprietorship means a one-person owner business. Okay? One person owns the business. They're responsible for everything, including the debts. Partnership, similar to a proprietorship, except that it's two or more people. Okay? They also have responsibility for everything that happens. Corporations are the most popular form of business, and that's what we're going to focus on in this course. Okay, business activities. Businesses engage in several types of activities in the course of their business. Okay, the first one is financing activities. Those are transactions with the company, with its investors and its creditors. So the company selling stock to its investors, the company borrowing money from the creditors. Investing activities are those that involve the purchase and sale of things that are going to be used in the business and expected to benefit the business for several years. Common examples are buildings, equipment, vehicles, those kind of things. Operating activities are transactions that relate to the primary operation of the company. What is the company's main business? Buying and selling whatever it is. All right, here we have the accounting equation. The accounting equation is the foundation for everything we're going to be doing throughout this whole course. Okay, the accounting equation says that assets, which are resources of the company, things that the company owns, are equal to the liabilities or the creditor's claims, how much the company owes people outside the company, plus the owner's claims, what this stockholders have in the company. Okay, so assets are things that the company owns, liabilities are things that they owe, and the stockholders' equity is basically what's left. All right, revenues, expenses, and dividends. Okay, revenues are the amounts recognized when the company sells products or provides services to customers. Okay, so it's their sales or their service income, revenue. Expenses are the costs that are involved in providing those services. So if you have to pay employees, if you have to pay rent, if you have to buy the items that you're going to resell, those are all expenses. Net income is the difference between the revenues and the expenses. Okay? Net income also sometimes is called net profit, sometimes earnings, but it is the difference between the revenues and the expenses. Dividends are not expenses. Okay? Dividends are distributions to the stockholders out of the profits. So giving the stockholders something from what the company has earned. All right. Financial statements. The accountants within a company measure the transactions, they record it, and they communicate those things out through financial statements. There are 4 basic financial statements. Income statement shows revenues minus expenses to get net income. Statement of stockholders' equity shows the beginning balances in the equity accounts, which we'll talk about in a minute, and the transactions that have happened. The balance sheet is the accounting equation. It's assets, and those total must equal the total of the liabilities and the stockholders' equity. The statement of cash flows tells the user where the cash came from and where it was spent. All right, income statement. Income statement is revenues minus expenses. If the revenues are greater, then we have a net income. If the expenses are greater, then we have a net loss. Okay? The income statement reports revenues and expenses for a certain period of time. Okay, so a month, a year, whatever it is. Okay, here's an example of an income statement that is out of the book. Now the amounts that are in blue there are a little off kilter. They should be over on the blank lines, but it shows the service revenue minus the expenses equals the net income. All right, statement of stockholders' equity. Stockholders' equity is made up of common stock, which is sold to the stockholders, and retained earnings. Okay, common stock, the company gets money from the stockholders when they sell the stock. Retained earnings is the amount of earnings that the company has made that they have retained. So the net income over the years minus any dividends that have been paid out to the stockholders. Okay, here is a statement of stockholders' equity, again from the textbook. The beginning balances, as noted there, are 0 because this is a brand new company. So they start off with 0 in those beginning balances. For an ongoing company, the ending balance at the end of this year becomes the beginning balance at the beginning of the next year. Okay, so we had 0 balances. We issued common stock. They had net income of $1,200, and they paid out dividends of $200. So the common stock is $25,000. The retained earnings is the net income minus the dividends to get to our balance of $1,000. Those things total $26,000, and that also totals $26,000 going down in the total column. All right, balance sheet, as I've already said, is the resources equals the claims to the resources. Assets equals liabilities plus stockholders' equity. Example of a balance sheet, again, assets on one side listed Total, 40,000. Other side, liabilities. These are the things that the company owes to people or companies outside of this company. You will notice that most liability accounts have the word payable in it. And then we have the stockholders' equity, common stock, retained earnings. Total assets equals the total liabilities and stockholders' equity. Hey, statement of cash flows tells us where the cash came from, where the cash went in these three categories. So operating cash flows involve transactions with revenues and expenses. Investing cash flows involve transactions with purchases and sales of investments and long-term assets like buildings and equipment. And financing includes transactions with lenders and stockholders. There is a statement of cash flows for the same time period as the other three statements we've already seen. Shows where the cash came from the customers, the cash went out for salaries and rent, cash flows from operating activities, purchase of equipment under investing activities, and financing activities, issue of common stock, borrow money from the bank. Those are both inflows of cash. Pay dividends is an outflow of cash. All right, this illustration is one of the most important things. Okay? It was when I got to this point in my first accounting class is when I became hooked, and I've been an accountant ever since. Okay? The financial statements all fit together. They all balance. If they don't, then you know something is wrong. Okay? Net income from the income statement was $1,200. That $1,200 goes in on the statement of stockholders' equity. The ending stockholders' equity shows up on the balance sheet. Okay? And the ending cash balance on the balance sheet is the same as the cash balance at the end of the year on the statement of cash flows. Okay? So the amounts flow from one to the other.